In 2026, your bank can legally take your deposits overnight. No warning. No permission, yet most people have no idea this is even possible. When you deposit your hard-earned money into a bank, you assume it's safely yours. But the truth is far more unsettling. In many countries, and increasingly within U.S. regulations, a hidden financial mechanism already exists that allows banks to use customer deposits to save themselves during a crisis. It's called a bail-in, and most people only discover it after their accounts are frozen or their balances quietly shrink. As financial pressure builds heading into 2026, economists warn that the global banking system is entering a risky phase where bail-ins could become more than just theory. Today, we're uncovering how bail-ins work, why they're legal, why no one talks about them, and what it could mean for ordinary depositors like you. Most people think banks collapse when they run out of money, but that's not how modern financial systems work anymore. After 2008, governments quietly changed the rules. Instead of taxpayers saving failing banks, depositors can now be used as the emergency fuel. This process is called a bail-in. It allows a bank to legally convert a portion of customer deposits into bank equity to stabilize its balance sheet, meaning your savings can be used to save the bank itself. Instead of shutting down, the bank survives by sacrificing your money. And because it's legal, you aren't required to be warned. This sounds extreme, but it already happened in multiple countries. And the signs show these rules may be activated again in 2026. And what's coming next reveals the part banks avoid explaining, so don't miss the next chapter. Economists tracking global liquidity cycles warn that 2026 is positioned at the end of a tightening era. When interest rates stay high for too long, pressure builds silently inside banks, especially mid-sized ones, holding long-term bonds that have now lost value. Many of these institutions are sitting on unrealized losses they don't want the public to see. If markets dip or unemployment rises, even slightly, the cracks could finally widen. Governments know this, which is why bail-in laws already exist to avoid messy bailouts that cause political backlash. Combine that with slowing economic growth and household debt near record highs, and the risk becomes clearer. Banks may need rescue, and deposits are the fastest tool available. But the real danger lies in how this process unfolds, and that's exactly what the next chapter exposes. A bail-in doesn't happen slowly, it happens when you're asleep. Once regulators determine a bank is at risk, they can freeze withdrawals instantly. Accounts don't disappear, they simply become inaccessible. Then, deposits above a certain threshold are quietly converted into bank shares or written down as part of the rescue plan. Customers wake up shocked, wondering how their balances changed without consent. But the truth is, in a bail-in event, the customer has no legal right to refuse. Everything occurs under emergency authority. No notifications, no warnings, no chance to withdraw beforehand. This creates the illusion that everything was fine yesterday until suddenly it isn't. But the most disturbing part is that bail-ins already happened before, and those real cases reveal what could repeat in 2026, which we explain next. Cyprus 2013 remains the most infamous example. Overnight, depositors with more than 100,000 euros saw nearly half their money seized and converted into bank shares. In Italy, senior bondholders and depositors faced losses during the 2015 to 2017 banking crises. In Greece, withdrawals were limited for months. Each event followed the same pattern. Governments insisted everything was stable until the moment it wasn't. And in every case, ordinary savers ended up carrying the burden. These weren't poorly run banks. They were part of a global system wired to prioritize stability over individual deposits. If it happened there, it can happen again, especially in an environment like 2026, where the ingredients are dangerously similar. But to understand whether your deposits are safe, you need to know who gets hit first, and that's coming up next. Banks don't automatically take everyone's deposits. A strict hierarchy decides who gets hit first. Step 1, shareholders. Step 2, bondholders. Step 3, unsecured creditors. And step 4 only after all others large depositors above the insured limit. In the US, that limit is $250,000, but insurance doesn't always mean instant payout. In a severe crisis, delays or temporary freezes are possible. Business accounts, retirement funds, and higher balance customers face the highest exposure. Most people never realize they are technically unsecured creditors to their own bank. That's why wealthy clients often diversify across several banks or shift to safer vehicles. The average person rarely gets this information clearly. And yet the biggest warning sign isn't who gets hit first, but how banks hide their weaknesses. That's what we're revealing next. Banks won't openly admit when they're in danger. Instead, they rely on subtle signals: sudden CEO resignations, rapid bond selling, rising unrealized losses, unusual changes in liquidity ratios, and quiet requests for capital injections. When interest rates rise, banks holding long-term bonds lose value on paper, but those losses can quickly become real if withdrawals increase. And in the digital age, a small wave of withdrawals can escalate in hours. Weak banks especially depend on customer confidence. Once that's gone, the system becomes fragile fast. This is why regulators push bail-ins. They need a backup plan before panic begins. If you know these warning signs, you're already ahead of most depositors. But what matters most is how to protect yourself, and that crucial information is coming in the next chapter. The first step to avoiding bail-in exposure is simple: diversify. Don't let all your savings sit in one institution. Spread deposits across multiple banks, preferably those with stronger capital ratios. Second, avoid keeping large amounts above insurance limits. Third, consider safer vehicles like treasury bills or money market funds backed by government securities. Fourth, stay alert to financial news. Silence is often the biggest danger. And finally, maintain some liquidity outside the traditional banking system for emergencies. These moves aren't about fear, they're about smart risk management. In a world where the rules already allow banks to use your deposits, awareness becomes your best defense. But the final chapter will show why 2026 might force the system to its breaking point, so keep watching. As global economies slow and debt levels peak, banks face increasing pressure from both borrowers and markets. If unemployment rises or property values fall, loan defaults spike, weakening bank balance sheets. Meanwhile, governments are already overextended, making traditional bailouts politically and financially difficult. This leaves one remaining tool: bail-ins. That's why 2026 is viewed as a pivotal year. It's not guaranteed to collapse, but the conditions are aligned in a way that could activate these emergency rules. The smartest viewers know that understanding the system is the first step to protecting themselves. Most people will ignore these warnings until it's too late. But you're already ahead. Stay with us for the closing that ties everything together. When you look at everything we uncovered, from hidden bank weaknesses to the legal bail-in rules already sitting in place, it becomes clear that the biggest risk in 2026 isn't the system collapsing. It's ordinary people being unprepared. Crises don't announce themselves. They hit when confidence drops, when markets shake, and when banks quietly switch to emergency mode. But now you understand how the game works, and that knowledge already puts you ahead of millions. If you want to stay protected, stay informed, and stay one step ahead of the financial shocks the world never warns you about, then make sure you join the community here at Money Timeline. We break down the truth others don't explain in a way everyone can understand. So before you go, hit like, tap subscribe, and turn on notifications, because the next video may be the one that saves you from the next financial surprise.